We brought different players in the personal risk game to have a discussion. We have Chris. Chris is from Experien. Roger, on the other sort of spectrum, is a full comprehensive financial advisor who also does sort of risk insurance. And lastly, but not least, we have Sabrina from PPS Mutual.
I've always believed that risk insurance is the first port of call for when it comes to financial planning. It lays the foundation to ensure you're the asset.
Trust is everything. I think when you're establishing a relationship with somebody who is either going to grow or protect your money. And it may not necessarily just be you that's dealing with this person. It might be your beneficiaries. It might be your children. It might be your spouse if you're no longer in the picture. 97% of advised claims actually get paid compared with 93% of claims which are submitted directly or not by a financial advisor.
You need to have a relationship with your advisor. You need to know their name, their phone number, their email. If something happens, they should be your first point of contact. If your advisor hasn't reached out in 2 or 3 or 4 years, then better start speed dating.
What holds us up is when we're helping our clients getting their policies in place and all their claims is you guys. You guys get asked for reports so many times. We really need your reports or else we can't get our clients insured and or their benefit paid.
So this session is sponsored by Experien, who we've had a long sort of relationship with. I think I've spoken previously that my own broker was a lady by the name of Tracy. She's unfortunately cannot attend today, so Chris has filled in her shoes. And the way I've sort of brought this session is that we've brought different players in sort of the personal risk game to have a discussion. And so first of all, we have Chris. Chris is from Experien, and Experien is, why don't you give that?
Yeah, so Experien is a specialist insurance broker. We predominantly cater to doctors and dentists. We've been around for about 30 years. So with Experien, where some of us are qualified financial advisors, but we only specialize in the insurance side of things. So we assist from implementation to review and claim, and there's no fee for our service.
All right. And Roger, on the other sort of spectrum, is a full sort of comprehensive financial advisor who also does sort of risk insurance. So Roger, give your 2-second spiel.
Yeah, well, comprehensive financial advice, and I believe that risk insurance is part of that and always have been. Sabrina and I have been in the industry for a long time and been colleagues for a long time and worked at different providers for a long time. I've always believed that risk insurance is the first port of call for when it comes to financial planning. It's the foundation, lays the foundation to ensure you, the asset, who actually creates, you can go to work and generate the income. So you're the asset. So you would insure your house and your car, but who pays for that? You guys. So that's the foundation of risk insurance. For financial planning for me. And then you got your investments on top of that, of course.
Yeah, and for those that I think I should have made it clear, sort of risk insurance is about insuring yourself. It's the income protection, it's the trauma cover, it's the total permanent disability, and lastly, of course, life insurance. Very sometimes morbid topics, but that's about protecting the biggest asset you have, which is yourself. And lastly, but not least, we have Sabrina from PPS Mutual. So PPS Mutual, I'll let you explain what you do, Sabrina.
So thank you. So I'm Sabrina Walmsley. I'm the state manager at PPS Mutual. We're a life insurance company who is registered under a mutual structure, which means we're owned by our members and those who take out insurance with us. So we look after doctors, lawyers, accountants, engineers, professionals with usually about 4-year degrees, so only certain professionals. And those professionals who take out insurance become company owners. And whenever PPS Mutual makes a profit, we actually give those profits back to our members and we invest them over the next number of years that they're a member with us. And after about 10 years, you can actually withdraw some of those profits tax-free. And we'll continue to invest them on your behalf. And we've been in the market since 2016, but we have branches all over the world. And our founding company actually was put together just post the Second World War, so in 1971. So yeah.
Yeah, awesome. Thank you, Sabrina. So I guess to start off, and this is why I put Roger and Chris in the same panel, is you can get risk insurance from either one of them. Make your case why you should be the one.
I didn't know we're up to the debate bit. Oh, well. Sorry, Chris. Because we're full comprehensive advisors. Look, there are advisors who just do risk insurance, as Chris does, and we call it life insurance comes on the category of risk insurance. And Chris does actually, well, Chris's company, Experien, do general insurance, which is your car, house, contents and everything, which financial planners don't. So you have to be a financial planner to be able to recommend risk insurance, which Experien can do. But of course, we can do as financial planners. But we're getting back to why you should come to me is because I've got 25 years experience in this industry, and I started out in risk insurance, and I understand it, and I've seen the benefits of it for many of my clients and even myself. But just apart from that, we do take in your risk insurance needs, but also look at your goals and objectives, and then look at your structuring that you need to go forward in to build your wealth, what your goals and objectives are. But then risk insurance, as I said, is just the foundation for me to make sure all that planning, pretty stuff up top can actually be supported. If you can't provide that income anymore because you're TPD'd or whatever it may be, at least you still got a generous amount of income from income protection, which is not 100% your income. It's these days between 60 and 80, depending who you go with. Which is an incentive. It's not 100%, but it's an incentive to get back to work and obviously earn your 100%. But the bottom line is risk insurance, I believe in it that much that it actually, the plans, that pretty stuff we do all up top, it can still maintain and keep going forward. You can still pay your mortgage, you still send the kids to school, you can still run your car, you can still have a reasonable lifestyle, and not just with income protection. And there's trauma cover, or also known as critical illness, which covers like the big ones that started out being heart attack, cancer, stroke. But now there's up to 60 conditions, depending on your provider, which you can actually is like a temporary thing, like a heart attack. With the advent of, you guys, of the survival rate of heart attacks and all those types of things, you're not TPD, but you actually can still get a lump sum, and you still got your income protection going. So when I said earlier, you can still pay your mortgage and etc. You've only got 80% of your income, maybe, if that much. What about the medical costs and all those types of things? Yeah, you do have private health insurance, but you also there's a lot of out-of-pocket costs with private health, outside private health and what have you. And the average cost from the Zurich report, that one, the white paper.
That's okay. We've got a better white paper.
It's around 150. Correct if I'm wrong, Sabrina. It's around $150,000 out-of-pocket costs for a bout of chemo with cancer. That's out-of-pocket after your private health cover. So it's important to make sure you've got all those things covered. But then further extent, and then if you actually TPD'd, where you're totally permanently disabled, obviously you get a different lump sum and your income protection will kick in. So your plans can still keep going and support your family and your ultimate lifestyle, retirement outlook you're looking for. But also, worst case scenario, if you're dead, that covers one thing: you're dead, you're dead. Your family is also, apart from the grieving, and you play off all the bills, and obviously your plan can still keep going. So you can still control beyond the grave. That's why you should come to me.
Roger, I hate to one-up you. You've been doing this for 25 years. I've been doing it for 26. No, but...
There you go, a little friendly competition.
No, seriously, it doesn't matter where you guys go, as long as you get the right advice and you get the right policies put in place. As long as you've got a good relationship and rapport with the person that's assisting you, it doesn't really matter. But if you've got someone that sets a policy up and then doesn't review it, or doesn't reach out and discuss the cover, or even discuss how the cover was put in place. So gone are the days of, you know what, I need 10 times my salary and that'll do. Most financial advisors or insurance brokers are there to set up a tailored product to meet your needs. So we want to make sure that if something was to happen, that debt is cleared, that medical costs are covered, carers costs are covered from retirement, if you've got income protection until retirement, that you've got your critical illness needs covered, that your children are protected. There's so many different things that we consider when we put in place an appropriate level of cover to meet someone's needs. And that's the optimum level of cover. So if I'm giving you, that's $4.5 million worth of cover, and you look at me and you say, you know what, there's no way in the world I need $4.5 million worth of cover. that's probably something that we discuss and we amend to suit your needs. So you might say, that's great, but my spouse is going to remarry and they don't need X amount of money for the next 10 years. So let's get rid of that. Or my children can go to a public school. They don't need to go to a private school. So let's amend that. So the idea is that you guys just need to be comfortable and content with who is helping you and that they're there all the time throughout this journey, because your personal and financial position will change regularly.
I might just add, I mean, it's such an important point. Trust is everything, I think, when you're establishing a relationship with somebody who is either going to grow or protect your money. And it may not necessarily just be you that's dealing with this person. It might be your beneficiaries. It might be your children. It might be your spouse if you're no longer in the picture. So I think it's really important. I think the other thing is that, you know, when we, our regulator, the Australian Prudential Regulation Authority, actually put out stats every year on how successful claims have been in the insurance space. And what we do know is that 97% of advised claims actually get paid, compared with 93% of claims which are submitted directly or not by a financial advisor. So I think, you know, it's very, very important to have somebody who understands the industry at the helm. You know, when we think about what we outsource, I'm sure that everybody in this room is smart enough to do it themselves. It's not that, you know, I think the issue is when it comes time to claim, will you remember what your contract has? Will you remember, you know, what the structure did? Will it equate to the right money in the right hands at the right time?
Or would you like to complete all that paperwork by yourself?
Yeah.
Yeah, no. I think it's the common theme sounds like you got to have someone batting for you. You got to have someone who you trust, and you got to meet that person regularly. So I'm just gonna do a straw poll here. Who in the room has had a chat with the person who sold them their? Okay, first of all, who has income protection in this room?
Should be everyone.
Should be everyone. Yeah. Okay, nearly. We got like something like 90%. Now, who has met with the person that sold them their policy in the last 12 months? So it's about half. Yeah. Yeah. So, and who hasn't met with them for over, like, have no contact with the person that sold you the policy for, say, 2 years and above? Yeah. See, yeah. So it's the same as the poll that we did in the group. And so I think one of the take-home messages from this is that it's vitally important to continue to have that conversation with that person. If not, there are people willing to pick up the policies, I guess.
But I think it's also important that you don't wait until something goes wrong. My doctor actually passed during the pandemic and had been part of my life for 20 years. And he had some insurance structured through his SMSF. And towards the end, he realised that there might be some taxation considerations, and he tried to change it on his deathbed. And the trustee argued that he was not of, that he may not be of sound mind. And the funds were caught up for over a year and didn't make it to his beneficiaries for quite some time while they struggled. So you do not want to wait until the last minute, and you want to speak to the right people. Really important that you've got your account on board, your financial advisor and your lawyers, in the picture.
There are most advisors or insurance brokers out there that would review any of your policies for free. And if it's worthwhile, we'll let you know. Just keep what you've got. It's good value. If you've got a relationship with your advisor and you're happy with them, keep it. If you'd like a new one, we can obviously assist. But it's our duty of care to let you know what you would gain and what you would lose with the policy regardless.
And to add to that, what Sabrina was saying, it backs Chris up, that get it as early as you can, because, have clients saying, oh, I might get that in 6 months' time or 12 months' time. I guarantee you something's going to happen. You'll develop some sort of ailment or something that's going to hinder your ability to get full cover without exclusions and what have you. So because they're betting on you now when you're healthy, and the younger you are, obviously, the better and healthier, because that contract is guaranteed renewable if it's not general group life, and then it guaranteed, and so you can take out base jumping. The insurance company can't do anything about it. They're still on the hook for that. Or smoking. I'm going worse extremes here, but you get the point. You've locked in your age at that, your health at your particular time in your life, or if it's younger, the better. and and you're just transferring financial risk to an insurance company. And as Chris was saying, with the review, we don't want you paying premiums unnecessarily, and that's why a review is important, because obviously insurance, this type of insurance is to protect the debts that you have. So if you can't pay that debt, you lose everything. But as your assets grow and your debt reduces, you need less and less insurance, because you can start to self-insure. So we want to help you actually reduce your premiums as you go, while we're helping you build your wealth.
Yeah. That's so. As I said, you stole my question. So I guess as young as possible is always the thing these days. Now, what is everyone seeing sort of in the market? Because like there's lots of, I mean, a couple of years ago there was a complete change of the insurance system. They no longer agreed sort of value products out there. I think also the level and stepped premiums have also sort of been completely changed. And I think one of the commentary that we always get is that, oh man, I got level, but it's still getting more and more expensive. So, there's some controversies, I guess, in the industry that perhaps clients are not really sort of up to date with. So maybe let's start off with the level and steps thing, the changes in that.
Maybe we'll just talk about the market first,
Yeah, sure.
and why. So,
Sure.
I mean, you asked about the structure of the insurance market, and a number of years ago, APRA intervened and said, listen, the way that you're doing business as insurers, it's not sustainable. It's not in the long-term good health of the industry, and so we're going to step in and
Policyholders.
yeah, or your policyholders, more importantly. But what they wanted us to do was stop selling agreed value contracts, and they wanted more bite in the contract, I guess, for long-term claims. They didn't want clients sitting on claim for long periods of time. So the nature of contracts changed quite considerably, and at the same time we had a very different economic environment. So we had a pandemic, which meant that mortality, morbidity rates, the forecast globally changed, and it impacted base rates for insurance. The health of the nation changed over that period, and we saw a huge spike in mental health, claims over the period of isolation. And then I think, the other thing that we saw was just, I guess, a low interest rate environment. So we had a persistently low interest rate environment, which changed how level premiums were priced across the board, because level premiums are effectively, the insurer takes they make a hedge, if you like, in order to lock in a rate. And so what they do is they invest in things like term deposits and bonds that can give them a return over time, and can stabilize the premium.
Supplement.
Yeah, supplement, I guess.
So in extension to that, when the interest rates were really low, the investments that the insurer invests in has not generated the return to cover that risk.
So it changes, but level is long-term insurance, right? So PPS Mutual, for instance, I've been with the company 7 years, and in my third year of working there, we actually had a different forecast for our premiums, and we realised for lump sum that we were actually overpriced. And in that instance, we passed back to new and existing policyholders a reduction of 23-25% for life and TPD respectively, over that period. So I think, for the long term, just because there is a period of low interest rates doesn't mean that if you're with a good insurer that things won't change. And level premium still has its place. It's just that the break-even point might be sitting at about 11 to 15 years instead of, where it might have been at 7 years, a long time ago.
I think it also depends on the way that someone would explain level premium. I've heard people in the past say, level premium is more expensive than stepped premium, but it's going to be guaranteed. That's not the case. Level premium is higher initially than stepped premiums. They will still increase. The idea is that they won't increase at the same increments as stepped premiums, and throughout time, it's meant to be cost effective. In saying that, actuaries at insurers do have the right to amend level premiums depending on the amount of claims. So one of the things that we do for our clients is we ask for projections from the insurers at regular intervals, and then we compare them to see when the cumulative premium crossover point is. Because if it was meant to be 8 years, but it's now 14 years, the client needs to know that.
Yeah, I think that has sort of happened in the last couple of years. Now, one of the things that, as we mentioned, during the pandemic, there was a lot more sort of mental health claims, and I guess how has that affected sort of the industry? And there's talks about not having coverage for certain work-related mental health things from an eye care from
Well,
a
maybe that's more on the
workers'
direct
compensations
side.
perspective.
Yeah,
right?
I mean, look,
workers'
I
injury
think that's probably more in maybe in the more direct world or in different kinds of insurance. In the life insurance space, for the retail life insurance space, that hasn't been a consideration for us. However, I can talk to claims in the PPS Mutual world, and actually for income protection, the leading cause of claim for our professional cohort is actually musculoskeletal. We've got dentists, we've got doctors, and you're standing over patients. Allied health, the strain on the body, its neck, its back, its torn rotator cuffs, it's all sorts of things that are impacting income protection, and they can be recurring. From a trauma perspective, it's still cancer. It's still 70% of claims, and cancer is not something that discriminates, as you well know, according to age. So, we do say get it locked in early so you've got a good contract, and, don't wait for something to go wrong. But yes, no, we there hasn't been any talk in our world about scaling back our contracts.
I think if we go back 15 years, if there was a mental health condition, it was an automatic decline from an insurer. Now there's different ways around it. I mean, there's exclusions more than likely that are applied, but they can also be reviewed depending on the condition and depending on the developments. So while there's an increase in mental health claims, it's good to know that there are insurers out there that will actually cover people these days.
Yeah, and how does that work? I mean, just like give us some example, because I think more and more often we see sort of younger people on antidepressants for a bit of anxiety, a bit of depression. How does that sort of impact? And this is not just for ourselves, but also for our patients. I guess it's kind of useful.
Yeah. So these days, insurers want to know about the history. They want to know about what the diagnosis was, whether there's a trigger point, whether there's medication, counselling, how long the condition's been present for. And based on all of that, they will advise what the terms are, but also advise when it's reviewable. So, if it was a one-off and it was triggered by a certain event, and there was counselling and, there may have been medication for a short period of time, they'll more than likely still put the exclusion on depending on when it was, but then say this is reviewable in 3 years or 5 years, and then obviously review and consider it at that point in time when updated medical information is provided.
Yeah, it's really important not to be afraid, if you've seen a counsellor or, you're worried about that, impacting your ability to get insurance. I think, many of us did especially over the pandemic period, but we have something we call the 3 C's in insurance, and that's cognition, compliance, and control. So what we look at is cognition. First of all, you're aware that there's something wrong and you're seeking help or you're seeking support. The compliance with the regime of treatment, and that may not necessarily be medicine, it might be counselling, it may be other pieces, and that, if there is a need for medication, that's being administered and you're taking it when you should be. And it doesn't always result in a loading or an exclusion. Sometimes it might just be a one-off. There might have been a family instance. And most insurers, if you're upfront and you disclose it and you're truthful about it, we'll find a solution for you.
Yeah, awesome. Now, have we got any questions from the floor? From the audience? This is time to ask any questions.
Are pretty sexy, aren't they?
Yeah, like I saw some of those graphs and I was just like, oh, that's amazing. Yes.
You're saying how important it is to have trust with your broker or advisor. Do you have any recommendations on what to look for or red flags that we should try to avoid?
So I assume I'm the island. So
So the question is what you're going to look for in an advisor or broker.
yeah, look, I mean, the first thing you can do is check the ASIC register to make sure that the advisor is registered and they are current. That's the first point. If you're having a look at reputation, you can go onto advisor ratings. And so that's a public website where people go on, they rate their advisor, they talk about it. You can also talk to our association. So there's the FAAA, which is the Financial Planning Association. And you can talk to them about whether this person is a member and whether whether they subscribe to the code of conduct and the code of ethics as prescribed by the association.
And once you've got that out of the way, then it's more of a point of every advice. Well, I don't know if any advisors who charge an initial consultation. Well, we certainly don't. I'm sure you don't. No, Chris. Just go and have a chat with them. I always give a new client an hour to chat, to get to know me, whether I think, I like them, they like me, and then to see whether I can really help them and provide true value. And it is getting to know each other and who you feel comfortable with as well. And you can go see a couple, the whole shopping around, but it's really more like who you feel comfortable with. First do all this due diligence, and then just go and have a meeting with them, because they'll all give you 45 to an hour's chat, and then you walk out of there feeling, yeah, this feels right, this person.
You need to have a relationship with your advisor. You need to know their name, their phone number, their email. If something happens, they should be your first point of contact. So, if your advisor hasn't reached out in 2 or 3 or 4 years, then, better start speed dating.
Yeah, I that's a good tag. My risk advisor, and I am qualified to do my own advice, but I guess it's a time poor thing, right? Like I'm certainly not going to do my own, because when it comes down to it, I don't have the time to administer it, properly. But it's someone whose full job is to do this. Well, that's great. And every year we sit in a review, and much like when I go to the doctor and they say, so Sabrina, what's been happening in your life? The same question gets asked. And, and there's a whole range of questions that need to be asked to make sure that my insurance is current. And once I think I said something really benign, like my former husband, just started a company. And she said, great, we can use that to up your insurance. That you have on his life, because, which I do, by the way, own a policy on his life. Every year at policy anniversary, it's his year. Yeah, it's almost close to $1 million now. So I'm just, yeah. There's someone that can cut breaks. No. Shh.
This is recorded, by the way.
Yeah, you just cut that bit out, please. But these are the things you want to make sure that you've got. That money covers private school fees in the long term. If Ryan isn't able to contribute, for his son, it also is a part of a will. That my son never will have to contest against. Because he has stepbrothers. So it may not necessarily just be about me. It's about my son too. It's about setting up firewalls around, around my son. Should I ever repartner, remarry? There are so many different considerations that it's not just about you. So I think you do need somebody who you trust, to be in that world with you and to be genuinely very honest about your financial position and the risks that present to you at any given time.
Yes.
I'm a bit confused about the policies. My understanding is that the advisor was same like the market broker, that they connect you in the insurance provider and they get commission from the provider according to your situations, and then you be in contact with them, but that's fine. But what happens when the advisor switches company, like they're with any particular firm now, but the advisor moves on? Who am I going to, suddenly someone, you go through your documents and gave you a sum with that. These are good points with this company. These are the bad points. But after 6 months, that person is not working at that position.
So this is generally where you lose contact and you lose relationships with a financial advisor or an insurance broker, because the original person that set things up may not be there. And then your policy is transferred to someone else within the company, and they may not be as diligent as the first person. So the idea is that, anyone that's and I'm going to be harsh, of quality as an advisor or a broker should be reaching out to you and getting to know your situation, whether you're a new client, whether you're an existing client being transferred internally, or whether you're an existing client going from one brokerage firm to another.
Yeah, I've called this the orphaned.
The orphan client syndrome, but I think that's really important because there's different models of advice. And when you think about structure, you walk into a Tesla dealership, you know you're going to get a Tesla, right? So you might have an advisor that actually works directly for an insurer. So they're employed by the insurer. And when you go to that advisor, all you're going to get is insurance that is sold by that insurer, right? So I think that's what you were talking about there, that the kind of anonymous advisor who sits within an insurance company sold you a policy, he's moved on. Whereas when you're talking about independent advice, which both these guys are on stage, they work for themselves. They can look at the entire retail suite of insurers, figure out what is best for your needs, that it's tailored to your needs and it's going to do the best for you and for your beneficiaries. And then, should that person move on, whether they're self-employed, whether they're employed, if that person moves on, then they'll likely introduce you to the next person. And there will be some continuity when you're dealing with an independent firm.
And yes, it is. Essentially, it's working like a mortgage broker does. We can look at the whole suite on the market and we can pick the right one that actually suits your needs, just like Eloise and Alyssa over there can actually pick, God, I don't know how many they can choose from, like bloody 100 lenders. They pick the right one for you. We do the same thing. So we act like a broker, but it's not really understood that way in the financial game. But it's the same actions. It's the same process.
Yeah, and again, we do see a number of our sort of membership like being orphaned, and so it's worthwhile reaching out to us and one of these companies here to discuss that. I think to get adopted.
And when we're doing our comparisons and looking at the insurance, when we look at all of them, we're not just looking for the cheapest option for you guys. We're looking at the quality, but we're also looking at the service of the insurers. So there's a few that I can think off my top of my head that I won't mention. But if I'm dealing with them or their claims process is not great, but they come out as the cheapest, we're not going to recommend them purely because their admin and claims service is terrible.
There's a lot in it. Yeah. Good one, Ash.
Yeah. All right. I think I listened to before.
Yeah, I normally see the benefit of the income protection insurance after seeing several of my colleagues being forced to walk away from their careers after health issues. But as you get older, the issue that I have is that income protection insurance becomes increasingly unaffordable. And you sort of say, and I've had several colleagues look at getting rid of it because they just cannot afford it. So how do you guys overcome that problem? Like, I foresee needing income protection insurance, definitely, really. But it's becoming so prohibitively expensive that it really becomes
unattainable. Well, that's right. That's sustainable. That's right. But that's why during a review we can actually say, well, look at the cost reward trade-offs to say, well, how much can you self-insure? Do you have enough assets, rental properties or shares or whatever it may be to actually supplement your income should you not be able to work? So we try and find a balance. Or you can reduce the amount of cover that you've got and you can push out the time periods of the waiting period or the benefit period. So you can, and that's what we have been doing a lot. A lot of older people, it's getting too expensive. So we just alter it and make it cheaper. So we might, which Sabrina will see that in the industry, a lot of people are re-rating, looking at their policies and saying it's too expensive, but maybe instead of having a policy to go to 65, I might just have a 5-year benefit period, or I might push out the waiting period to 6 months. Well, can you afford to wait 6 months plus 1 month before you need to call, you got enough money to sustain you from them? So again, that's what the review process can do. Say, well, can you afford to reduce this or get rid of it altogether, or can you afford not to? Because the old cliche that's been around forever is if you can't afford the premiums, you can't afford not to have it.
Also, it's all about mitigating risk, right? The position that you were in when you took this policy out may not be the position that you're in right now. So the idea is that we need to make sure that, changing waiting periods, benefit periods, removing certain ancillary benefits that you may not even know about, that you may not need off the policy, they'll all adjust your premiums. You can have premiums paid through super if you really needed to. But the idea is that making sure that we amend the policy to suit your needs at that point in time. Now, keep in mind, in 2021, there was a change in income protection. The policies aren't as good as the policies that were in place before 2021, but they're still good policies. And the cost between those two different policies can sometimes be huge. So would you rather have some cover or no cover at all?
Okay, can I use myself as an example? So last year, what I did was I was on the agreed policy, which I took out before I did my PhD, as some of you would have seen. So PhD, if I fell ill, then I would have no way to justify my income. Whereas like now I earn actually a lot more than what I'm insured for. And all I've done was I just switched from agreed to indemnified value because now I've got consistent income and I've actually saved something like 20 something percent. Yeah. So it's just something simple like that can actually help adjust the cost of income protection.
Another thing with income protection is people need to remember that there is at times income offset clauses with some of these contracts. So if you're going to have an ongoing income, even if you're not working due to illness or injury, that may need to be taken into account with regards to the benefit that you can actually obtain.
So does that include your passive income that comes in through rent and
Could do.
could do? Yeah.
Depending, the good thing about underwritten insurance is you get to disclose everything up front and the underwriter gets to make a decision as to whether they will cover that or not cover that, but there are some that, that might be a little bit more liberal up front and there's a little bit more scrutiny on the back end. And I know with PPS, we take more scrutiny up front. So it might be a little bit more pain up front when we're asking questions about your financials, but we know that, come claim time, that's the amount of cover that you've got is the amount of cover you're getting, kind of.
Yeah.
So you're not paying for something you might not
You
get.
don't get, which is, ethically not right. Yeah.
So can I just put the case, say, now I'm 60 and I've got, $200,000 worth of income protection cover a year, but I'm making 150 passively through my, real estate empire. Does that, if I do fall sick?
But yeah, I mean, it depends on whether it's an old contract, a new contract. The new contracts do have, an offset, that's got a built in. You can't go over in many cases 70% of what the earnings, your predisability earnings.
Yeah, but my investment income.
No, but generally speaking, income protection would cover you for personal exertion.
Yeah.
Yeah.
Okay, so if I, my personal exertion was 200K and I've got like 150K of passive, if I fall ill, I'll still get my 200 and I still get, a part of my 200K covered, or is that?
Well, yes, technically you would. I mean, this is more for Sabrina. But again, that's when you get a review and say, do I need to pay all these premiums for $200,000?
Yeah, I think precisely that's the point. It's like when you first got the insurance versus much later on, what does that look like? Yeah.
I mean, so you talked about agreed versus indemnity contract. So the agreed value contracts are no longer sold, right?
Yeah.
So I've got an endorsed agreed value contract and it's very, very expensive. I actually claimed on it 6 weeks ago. I broke my ankle and I didn't even realize I had a claim until I spoke to my advisor. He said, Sam, you've got a claim, go. And I got a tax-free lump sum because of the nature of the injury. But those sorts of contracts are no longer sold. It is now indemnity. And it means that you cannot exceed more than 70% of your pre-disability earnings. So that means if you do have passive income that pushes you over, then the amount of money that you get at the end of the day could be offset by the passive income that you're earning. Unless, of course, an underwriter has said, look, we acknowledge that you're getting this, this other source of income, but, or this business ongoing income that might be your practice income. And then we may, offset a portion of that. So
work covers offset. I mean, work covers.
So I guess the answer to that is check with your
provider. Because one company may not have a passive income offset, but you may need to be careful of your business.
It'll pretty
income.
much be on an individual basis.
All right, I think we had 2 more questions. There was one here just now. Yeah.
So, if, for example, if car insurance really lodge a claim that the insurance was gone, what happens with personal insurance?
So just rephrase that for me again.
So if, for example, I've got my car and it's sort of written off.
Yeah.
So I get a replacement car, but my policy is gone. I have to get a new policy.
Well, if you're written off, yeah.
So I think the question, I'm going to rephrase it, is like if you end up having TPD, say,
Can you get a reinstatement?
yeah.
Yes, we have reinstatement options. Yeah, so there are reinstatement options.
But are you talking about income protection, which is a replacement of income, or the other three, which are lump sums? Yeah. Yeah, well, income protection is like a car. If you get a scratch on the car, it goes and gets fixed, and then your policy continues. Income protection is the same. If you're off for whatever, you break your leg, 10 days, whatever it may be, then you go back on your policies back in force again. Yeah. So it's like, think of like a car one, but if the car's, that's not a good analogy, the car written off against it, or else that's your claim your death policy then.
Yeah, that's a death policy.
Yeah. If somebody had cancer or something. Okay, so then when we talk about our lump sum claims, there are things like reinstatements built in, which you do need to pay extra as an option for at the beginning of the contract. There are also things like life buybacks. So if your TPD is linked to your life and you have a TPD claim, it will reduce your life by the same amount, and in which case after 12 months it will automatically buy back your life cover. So or you can actually get a 14-day one as well, which is a little bit more expensive. So I think there are a lot of different options, but you've got to work with your planner to structure the right options and make sure that it's within your tolerance to pay for those options.
Yeah, that's right. It can be a bit of a minefield, like understanding of how double TPD can work, or because you can have a life policy, $1 million, and a TPD policy linked together. Because you claim on the TPD policy, your life policy can be gone unless you've got double. So there's a lot of these things you've got to understand. Or just say it's $1 million and you $500,000 TPD, and you claim on that 500,000, you've only got $500,000 left. Then you've got to understand, is that okay? And that's why you need to review it and make sure you get the proper advice, because of all these options that you can choose, which you could be sold these policies that got all the bells and whistles, and you might not need them on. You're paying all this money, so it is good to talk to someone to say, well, what happens if this happens? Well, it depends on that's what we're saying. It's all individual about your personal circumstances, your extended family, what
Okay,
they
Roger,
may need or may not
I'm
need.
going to interrupt you because we got two more questions, one over there and one on table 5. Yes. How many providers? Yeah. There's actually very few.
Yeah, so in the retail advised market, there's 7 now, I think, after consolidation. Yeah. So, there has been a lot of market consolidation, but 7 retail providers.
So the 3 big insurers, which are TAL, Zurich and AIA, have bought or taken over some of the smaller insurers. So 7 altogether now, but there is sub-insurers that would be part of it. So OnePath is part of Zurich, ComInsure is part of AIA, things like that. Yep.
Yeah, so it's very consolidated. And last question, table 5.
As health providers, is there any particular resources that you would suggest for us to help our patients to obviously say, check with your advisor if you've got cover, but around time frames to claim or how many claims to be
Oh, so the question is how resources for doctors advise patients.
Is it resource for your patients, or is it more for you?
For us, so for example, if you came to see me with a broken ankle, I would have not even thought about with your advisor.
Yes.
And if you come to see me at the time or 6 weeks later, as opposed to a year later with some ongoing pain, then is there a time limit for coming back and asking?
Yeah, of course.
Sure, it's in the background. I do suggest that.
There are a lot of helpful resources online, that you can have a look at. All of the major providers do have an open website. So if you go onto PPS Mutual, there's information about what the different covers give you, and and what sort of conditions they cover. So that's all there. In terms of you handing out any information in regards to product, it actually couldn't pass through your hands. It has to pass through an advice giver. So the best thing always is, if you've had somebody that's come in with a trauma, cancer, heart attack, stroke, angio, bypass, those are sorts of trauma conditions, that you refer them to the financial advisor. If they look like they are totally and permanently disabled, financial advisor, even for a break, like an ankle break like I had, that was a big one, and and speak to your financial advisor.
The good news is that people can retrospectively claim, and a lot of the time they won't actually know that the condition that they had was claimable. So I had a client who had a mole cut out, had half a day off 3 years ago, and we got her a benefit. So
Yeah, me too. You'd think, why didn't you know that, Roger? Because I didn't know angioplasty means stents, right? So I had 2 stents put in. It wasn't traumatic because it's called trauma insurance. And a year later, I'm looking through the PDS and I better get an update. Okay, angioplasty. Oh, hang on a second. Wasn't that the thing that I had? 12 months later, I put in a claim. Within a week, it was paid. It was like quick 50 grand. Like, oh, wow, okay, I can handle that. So, yeah, you can get paid retrospectively. But I think what might be beneficial for you guys, if we could probably send out something which I think might help is a list of, podcast, but there's a list of what trauma can cover, which I think in your world would help. If we just give a list of what generally is covered across the industry, you can go, oh, you may, if you've got cover, this may cover you. So you're not giving advice or doing any of that. Because we know what income protection covers for you. If you can't work, simply injury or illness, you know that covers you. Dead, you're dead. TPD, you're pretty nearly dead. And trauma is the big one in between, because that's why it costs more, because it actually covers a lot more conditions. So, but we will. I'll talk to B. We'll send you a list of generically what they do cover, and you'd be surprised at what it does cover.
Yeah, because like for instance, I work in ED. I see broken ankles all the time. I never tell them, say, have you got trauma cover? You can go get some money.
specified injury under income.
Oh yeah, no, just mention it. I never mention it, but like that's a great thought over there.
We'll have a chat with you.
All right. So thank you so much for answering some quickly questions. And
could I just say one thing? Look, we all whinge about. What holds us up is when we're helping our clients getting their policies in place and all their claims. Is you guys. You guys get asked for reports so many times. Who's been asked write a report?
I'm sure you hate us for it.
Yeah, and you get hounded, don't you, by UHD or someone? Yeah. So we really need your reports, or else we can't get our clients insured and or their benefit paid.
I think a lot of people love UHG.
Yes.
Maybe if they paid more.
They pay well.
All right. No, thank you, panelists.
Thank you.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.